Thank you for joining us. We'll get started now. Good morning. I'm delighted to welcome our first keynote speaker today, Dan Coleman, from the CEO of KCG. Dan needs no introduction to all of us, both as an industry and as a thought leader in market structure. So Dan, I'll let you come up and speak for yourself. Thank you for joining us.
Thank you very much. And you see from the title, it's sort of the direction I'll be going in. I don't work at a bank anymore, but I'm cognizant that many of my friends have deferred bonuses and they're going down. So thank you to the World Federation of Exchanges for inviting me this morning. I really appreciate the opportunity to come speak. My name's Daniel Coleman. I'm the CEO of KCG. We're a 3.5-year-old firm based in New York. One of the world's leading market makers. We have about 15% of the U.S. equity market and about 15% of the U.S. ETF market. We're also a cutting-edge algo provider offering access to European and U.S. clients to the equity markets in the U.S. and Europe. And we operate one of the largest fixed income ECNs for corporate bonds and municipal bonds called KCG BondPoint. And whether we're providing liquidity directly to our clients on exchanges or working with clients to provide innovative solutions to access liquidity as an agency broker, or whether we're running a bond trading platform, it is our strong view at KCG that our mission is to drive down the costs of buying and selling liquid financial assets. And the reason why we think this is important is because we think that if you drive down these friction costs, investors keep more of their investment, and people who need that investment, the entrepreneurs, have a lower threshold of capital returns, and that more of that money can more easily come to entrepreneurs and come into the real economy. Also at KCG, we strongly believe in market structure that promotes competition, because we think market structure like this puts investors' long-term interests over the short-term interests and profits of intermediaries. And make no mistake, we're an intermediary and we want to be profitable, but we think this is the right thing to do in the long run. Now, a lot of people are talking about what's going on and what has been going on at banks. And I've heard the capital position at banks called the capital cocktail, because there are all kinds of rules and they're starting to pile up. And banks are beginning to say, well, wait a second, what's going to happen? I've got all this capital I have these liquidity ratios, I have leverage ratios. What is going to happen? And are there unintended consequences? And there are obvious things happening. The return on equity is going down. I would argue that banks' ability to pay dividends and buy back stock is going down. But there are also questions as to what's going to happen with respect to banks lending money into the real economy and what's going to happen to banks buying and selling securities. And banks would lead you to believe that liquidity is going to dry up in a lot of the banking product markets they're involved in. And they honestly feel that way. And I would say that doesn't have to be the case. What has to happen is not to change the rules to provide more liquidity. We don't have to sacrifice the stability of our banking system for liquidity in the securities markets. What we need to do is change the market structure of some of these markets so liquidity can evolve itself. And so I've done a very unscientific study, but this is mainly to show you what I think is going on, and I think many of us will recognize what's going on. I took a sample of 4 exchanges and 4 banks and looked at effectively their stock price over the last 6 years. And the exchanges were CME, ICE, and Deutsche Börse plus Market Access. And Market Access is the leading bond ECN in the U.S. And the banks were JP Morgan, Bank of America, Deutsche Bank, and Goldman Sachs. And you see here in my portfolio of exchanges, it's gone from 100 to 350 over 6 years, about 25% a year growth, a little bit less. And banks have gone from 100 to about 105. So something's going on here, and I would argue that some of these banking rules have already had an impact. Some of these rules have caused people to trade futures as opposed to swaps. Some of these rules have required people to put their positions into clearing corps, and people are trading corporate fixed income on platforms like they never have before. So clearly, from my point of view, there's a real value transfer from banks to exchanges. Now, I don't think that's that debatable, and I don't want to focus on that. What I really want to focus on is why that's good. So let's take a big step back, and I feel like at an exchange conference I shouldn't have to take a step back this far, but I also feel like many times I'm in conversations at conferences like this, and people talk about market structure and changes to the rules, and I feel like a lot of times people forget why we're here and what our role is. So generally speaking, risk transference is the ability to buy and sell liquid financial assets. At least that's how I'll define it today. And that's important because investors have different utility curves. It's important because investors want to move their money to where it'll get the highest returns. It's important because entrepreneurs are willing to pay the highest returns where that capital is needed the most. We all understand that. But to make this work, we have to standardize this movement of ownership. We don't want to buy and sell loans and take 2 weeks. We want to standardize in securities. We need to have rules in markets. We need to have rules on how we access these markets. We need to have rules on how things actually settle. And this all costs money. It's a friction cost, but it's okay because it leads to liquidity. And another friction cost comes because investors rarely buy and sell at the same time. So you need people to buy when investors are selling and sell when investors are buying. These liquidity providers are another friction cost. And the liquidity providers make money on the bid ask and they lose money on carrying positions they don't necessarily want. So that's the importance of risk transfer. We're here and we're natural friction, but this friction exists to promote liquidity. So the players in a risk transference are the players in a market like this. In a market structure that has competition, you'll see different roles. You'll see exchanges and ECNs, market makers, clearing corporations, and brokers. And with each one of these roles, there's competition. Now, sure, exchanges can own clearing corporations, and we're a market maker and a broker, for example, but there's competition among all these different venues. And in a risk transference ecosystem that works well, there's a couple of other ingredients. And one of those ingredients is accessibility and transparency. And what that does, accessibility and transparency means that it invites competition in, and transparency means that everyone has the same information at the same time. And that is really critical to having intermediaries provide the best possible service possible. Now, I would suggest that a market like this doesn't need as much capital as some other markets because of all the competition and not having asymmetric information, capital turns over very, very quickly. It's recycled in markets like this. And I would say the best example of a market like this is the much maligned U.S. equity market. And while the U.S. equity market is complicated and it has many pitfalls, I would argue it's one of the most competitive markets in the world because of the way it's set up. And I say at many conferences, it has the worst market structure in the world, but all the others. And I kind of feel that way. You can't come up with a better, more competitive one. And some of the pitfalls, I think, are worth enduring. Let's look at a different risk transference cycle. And you'll find banks in every single node of this. And this is clearly not competitive. It's almost monopolistic. But more importantly, this market structure doesn't promote transparency, it doesn't promote competition, and because of the asymmetry of information, the intermediaries themselves are not able to recycle capital very easily, so it requires a great deal of warehousing of risk. An example of this market structure is the U.S. Treasury market. 58% of U.S. Treasuries are traded by 5 banks. Over 50% of the volume happens in the dark. It's opaque. No one knows what happens. There's complete asymmetry of information. Even up until about now, the regulators don't know what happens. This market requires warehousing of risk for it to work. And it is not just a bad market with respect to friction costs. bad for U.S. taxpayers, the issuers, and bad for investors who buy and sell. But this market's going to get worse because banks' ability to warehouse risk is going down. Their ability to run carry trades is going down, and so they're not going to be able to provide the liquidity in darkness the way they were before. And here's an example of what I mean. In 2007, this is based on the primary dealers in the U.S., their positions in credit fixed income were about 20 banks, about $300 billion. Roughly the same group of banks today have a position in credit fixed income of about $10 billion. They cannot warehouse the risk that they could before because they have to term up their funding and because the risk requires a great deal of capital. So the markets that require warehousing of risk are going to have a real problem functioning going forward. So to that point of view, the banks are right. Liquidity is going to be a problem with the new banking rules. And you see a little bit of evidence here in the turnover ratios of U.S. corporate bonds, U.S. treasuries, and U.K. government bonds going down. It's just a little bit of evidence, but I would argue again that this doesn't have to happen if the market structure could be more like the equity market structure, or a market that invites competition and has a complete transparency of information. And so, in concluding, I'd like to go back to the slide of my portfolio of ETFs and my portfolio of banks. And rather than look at stock prices, I'm looking at market caps here. And if I go to about 2014, and I would say this is about the time where a lot of the rules were really coming into the market, from that point till now, my portfolio of banks has gone down by $40 billion. But from that point to now, my portfolio of exchanges has gone up by $15 billion. And I thought about this for a second. I know I'm oversimplifying things, but I thought about it and I said, I wonder where the profits went that supported that extra $25 billion, a market cap that disappeared. And then I realized, of course, they went to investors. Thank you very much.
Thank you, Dan, for an interesting and thought-provoking couple of minutes. We'll move swiftly on from that right into our next panel, which is fixed income, a key issue for all of us in this room. Our moderator is Jorge Alegria, who again needs no introduction to the WFE audience. To his far right, we've had Dan Coleman, who we've just heard from. We have next to Dan, Donna Nemer, who's Director of Capital Markets and Group Strategy at the Johannesburg Stock Exchange. Next to Jorge, we have Robert Scharfe, who in addition to being the chairman of our Governance and Nomination Committee, is CEO of the Luxemburg Stock Exchange. And finally, to my immediate right, Eric Noll, who's chief executive of Convergex, and again, no stranger or needs no introduction, frankly, to the exchange world. Jorge, it's all for you.
Thank you. Thank you, Nandini. Thank you very much. Good morning to everybody. It's a real privilege to be here again at this conference, at the WFE General Assembly Conference. So thank you for the invitation. And also thank you and congratulations to our hosts, Juan Pablo, Bolsa de Valores de Colombia, ASOBOLSA, and all the sponsors and participants of this great conference so far has been great. Thank you very much. I think after the excellent presentation that is actually it helps to be as a great introduction as well for this panel. In the last years, I would say that we have been discussing several topics in these conferences and others. Electronic trading, high-frequency trading, more recently, central clearing, and obviously the big issues now on blockchain and the new technologies. But there's also a very important transformation in the market that, although has been touched in several panels and several papers and several the other conferences, is extremely important because the size of the market, which is the fixed income market. There's a little doubt that there's something going on in the fixed income industry, in the fixed income markets, as a consequence of several external factors. New regulations in place affecting everybody in a different way. And as we saw in the previous slides, there has been a shift, an important shift in the holdings in the inventories of the dealers or the traditional banks. And at the same time, if you see a similar chart that we saw, but if you see the assets under management on the holders of the bonds that, by the way, have been experiencing record issuance in the markets. So bonds are being issued because the low interest rate environment seems to push that. But those bonds have been gone not to the balance of the banks, but to the assets of pension funds, mutual funds, ETFs. So that's clearly a shift, or there's clearly a change in the market structure in the fixed income world. We have several studies. Recently, IOSCO published one. There's several papers also published on the matter, and there's actually a debate if there's really an impact on the liquidity. There's a debate on also where is that impact? Is in Europe? Is in Asia? Or is in the Americas? Seems to be different effects. So clearly we are drowning in a sea of information, but we are still thirsty of getting the right information on where is this market really, or where is this market structure shift going to. So I hope that with this panel today, we can certainly help to address that. And I'm thrilled to have a part of this panel, and thank you very much for joining me. Let me start with Robert, with Europe. Robert, as CEO of the Luxembourg Stock Exchange, just as a brief introduction, is a place where you have 26,000 bonds listed in the Luxembourg Stock Exchange. 26,000 different bonds listed from 3 different issuers in more than 100 countries. Now, on a yearly basis, this represents about an average value of $1 trillion of bonds listed in Luxembourg. But it is clear that listing, it doesn't mean trading. So, Robert, what can you tell us about this fixed income? What's the status of the fixed income markets in Europe?
Thank you. First of all, does that work? No, it works. Okay. Now, first of all, I would start by saying when I started my career in the financial industry, in fact, it was for more than 35 years ago. In fact, this was on the fixed income trading desk. The first thing you learned at that time was, to have a market, you need buyers and sellers. And if buyers and sellers do not show up at the same time, you need somebody to stand in the middle. That's what we called, and we heard it a couple of minutes ago, warehousing, or the warehousing risk. And in fact, all these years later, we are still talking about exactly the same type of problem. Now, before I get to that, a few words about the environment. We are talking about fixed income market, we are talking about liquidity problems, and I must say I need to start with a comment to get rid of my frustration, my personal frustration, because all the efforts that have been done in fixed income markets to create a broader market to serve the interest of the investors. In fact, when you put this in the context of the quantitative easing program of the European Central Bank, which is basically killing all fixed income markets, from the sovereign debt market up to the corporate debt market. But that's something which we have to live with, and when you're looking at the most liquid sovereign debt markets in Europe, only a small fraction of these bonds are tradable against cash these days. But that's the way it works. The second thing which I would like to add is, having been a banker most of my career, in fact, I'm still very much connected to this world. And when I see, in fact, the state at which bond trading desks at banks look like, it's a real disaster. And you know, this is extremely important when you're looking at how is the market functioning and who could play a role in there. So in fact, these are starting points which do not look very, very nice. Then I would like to add a few numbers, in fact, because the question then is, do exchanges play a more important role? And the answer is clearly no, or maybe, in fact, not yet. And just to give you a few numbers from the SEP study, which I got hold of, in electronic order books of exchanges in 2015, we had roughly 700 billion euros of volume. Now, 700 billion is not very big, especially if you put that in the context of a global market. That means also OTC included, of more than 21 trillion. So it's roughly 3%. And the contribution that my exchange does to all of this is a fraction of all of that. Now, the good news in there, which surprised me a little bit, was that when you're looking at this 21 trillion of volume, there are 12 trillion that are dealer-to-customer transactions, of which 80% are reported to exchanges. And that's extremely important for the price formation and the price communication to the market, because basically that's what we need going forward. So overall, the state of the market is, at least from a European point of view, not very optimistic. But maybe, in fact, we turn a little bit more positive in the course of the discussion here.
Yeah, thank you. And sometimes that may represent opportunities, as you mentioned, for the role of exchanges or the other venues that we may discuss as well. Donna, let me go to you. JSC is working in a project that may be useful, especially considering the audience, to learn about developing an MTF platform in Johannesburg, and also looking for a primary dealer structure to put in place. So how can you, or what can you tell us about it?
Well, thank you, Jorge, and you did a very gracious greeting in English, so let me try one in Spanish, in my bad Spanish. Buenos días a todos, y muchas gracias por su hospitalidad. So that's enough of my bad Spanish. With regard to the project we're working on, and as we go through the panel, I'll certainly share some of the experience. And I'm reminded of those of you that heard Bob Cox over the last couple of days talking about a coalition of the unwilling. I think that is to some degree what we've got. But I do want to say straight away that I do believe that there is a very important role that exchanges can play in the fixed income market. But there's some very important things that one needs to think about as we get into it. And I'm learning as I go, to be honest with you, because it's not a natural space, quite frankly, for those of us that have our foundations in the cash equities market. I thought Dan did a great presentation this morning, and I commend you on it. It really got to the heart of the issue in a very few slides. And we can all watch that presentation and say it makes perfect sense, and how could anyone think anything differently? Well, the 2016 Nobel Prize winner, Dr. Holstrom, presented a paper to the BIS in 2014 saying, keep your equity hands off the fixed income market. It doesn't need transparency. We don't want transparency. If you introduce transparency, you're going to provoke the very crisis that you think you're trying to prevent. So I encourage you to have a look at that paper. He actually compared the repo market to a pawn shop. So I encourage you, if you want to see the contrarian side of this, to have a look at that paper. I don't agree with his conclusions, but I think it goes to show that there are many sides to this argument. And it really isn't a natural place for exchanges to be, but I do believe, as I was saying, that the The question that was being asked in the papers that were circulated as to, is there a role for neutral third-party players? The answer is yes. There are already neutral third players playing in this market. And the question, and to me, the challenge is those of us running traditional exchanges is we better get into this game because there's a great opportunity here. So just, if I could, Jorge, just one comment, Dan, to the presentation you made. I agree with what you showed in terms of what you call the suboptimal model. A lot of people refer to that as the onion model, where you have in the center of the onion the market makers that provide the prices and the liquidity to the rest of the market. And I think that's the model we have in Europe, and the model in South Africa is very, very, very similar. The issue is there is a lack of transparency in terms of price discovery, but as long as you had the ability to discover inventory, and that inventory was being priced to the market was feeding as the outer layers of the onion, off the center of the onion, the market was working well. The problem is now there is a challenge, as you showed in your slides, that we don't have, or we're having a reduced capacity to discover inventory. So the challenge I throw out to our discussion is the problem that we're all trying to solve here one of price discovery, or is the problem one of inventory discovery? So let me leave it there.
Yeah, can I make a quick comment? And I would defer to a different Nobel laureate who passed away. I can't remember his name, but he wrote a paper on the problem with lemons in the used car market. And the problem with lemons is that no one has the information, so it hurts the value of all cars that are used when you purchase it. And that's exactly what's going on in the fixed income market, and that's exactly why you can't recycle capital. I haven't read the other paper. I'm not sure if he's ever traded fixed income or bought a used car, but I think the issue really is this asymmetry of information, and certain people have advantages and certain don't. And because of that, it impedes competition and it impedes capital flow, and it requires warehousing of risk. So from my point of view, this is not just about exchanges in fixed income, it's about the whole market ecosystem in fixed income, and surely less liquid products have a different challenge than more liquid products. But from a liquid product point of view, I see no reason why fixed income should be any different than any other security.
That was actually quite good. Let me continue on that, Daniel. What about if you can go a little bit deeper on the U.S. Treasury market, or the U.S. market in general structure? Robert discussed a little bit or presented a little bit on the European side. What about the U.S.? You hinted a little bit in your presentation, but why don't we go a little bit deeper on the U.S. Treasury market structure?
Sure. So you have what I would say is the most important market in the world with respect to price discovery, because to some extent all assets are discounted on the U.S. Treasury curve. And yet, 3 foreign banks and 5 banks have all the information. You have SAFE, you have the Bank of Japan, you have the Federal Reserve, and they own about 1/3 of the market. And then you have 5 primary dealers that trade 58% of it. And the rest of us get the information later. And that's a big problem for a lot of reasons. But one of the problems is it creates dislocations when you have a group of people think they're trading on all the information and realize they don't. And if you go to the report where I believe it was the Fed, Treasury, SEC, and CFTC did a joint report on what happened on October 15th, 2014, the U.S. Treasury market, there were wild swings in the lit market that traded on BrokerTec and eSpeed. And they did this big report, and you read the first page, and they say, we don't have half the information of what happened that day. We don't have it because the banks have it, and they don't share it with us. And we have no mechanism to take it and look at it. And that's really, really scary. So from the point of view of the Treasury market, and the Treasury market's $13 trillion, it trades $500 billion a day, so it actually is an easy market to trade. All the securities have a mathematical relationship with each other. It's not like the U.S. equity market that has 13,000 securities, 17 trillion, and a lot of the securities have nothing to do with each other. The Treasury market would be a very easy market to become lit for everybody. And in many ways, there's a real sense of fairness of information in the Treasury market because it immediately impacts Treasury futures, Eurodollar futures, as well as swaps all over the world. So to have the market bifurcated like this is, I think, not just unfair, but kind of dangerous. So what I would say in general about the Treasury market, it's about a quarter of the way there. There's some real impediments. You need real-time transparency. You need a clearing corporation that will make it easier for non-banks to trade. And ironically, FIC, the clearing corporation, is owned by DTCC, which is the equity clearing corporation, but they don't compress trades. They charge by trade. It's really, really expensive if you're a liquidity provider who trades a lot. So that needs to change. It needs to have real-time transparency that everyone sees. And then I think various venues, whether they're BrokerTec or eSpeed or exchanges, will arise and bring it all together. I think that market in particular is ripe for a transparent liquid market, and I think it'd be better for Treasury traders, but it'd also be a lot better for everyone who needs to know real-time prices of Treasuries.
Thank you. I'll go back a little bit later on all the settlement issues and the problem it represents for the better development of the fixed income trading. But let me, Eric, go to you. And because of your background and your experience in market structure, what can you tell us about the exchanges or the evolution of this market and how the exchanges look to participate in the fixed income space?
So I'll start with perhaps a little background on the U.S. Treasury market, which we've touched on in a bunch of different ways this morning, but that market has traditionally been what we call a dealer market. So U.S. Treasury issues bonds, primary dealers buy them, they distribute to clients. The secondary trading traditionally used to be you went to your dealer or family of dealers to transact or find liquidity. And the way the dealers dealt with their inventory then to balance their risk and so forth was they accessed systems like BrokerTec and eSpeed and so forth to preserve that dealer market and to flatten out their risk over time. Following the financial crisis, and it was a trend in some ways being driven by the buy side as well, looking for better transparency, what we've seen is the move from liquidity providers away from the primary dealer market to other alternatives. KCG being one of them, but there are many others. So when I was at NASDAQ and we bought eSpeed, one of the things that was intriguing about us about the eSpeed stack of liquidity providers is there was no primary dealer in the top 5 liquidity providers on the system. Not only were there no liquidity providers in the top 5, there was only 2 primary dealers in the top 10. All the rest of the dealers fell well below that. So all of the liquidity provision in the secondary market in on-the-run treasuries was being provided by firms that, like KCG, but also firms that you've never heard of before. Electronic market makers, high-frequency traders who were providing that liquidity. And what we saw at NASDAQ when we bought eSpeed was this notion that what was a dealer market was moving towards an agency market, toward a transparent market where liquidity providers provided liquidity, brokers provided connectivity and execution, and venues would start to evolve. Now, there's been a lot of bumps on that road. There's been a lot of resistance to making that model come forward, but I think we're on the way for that. I don't think that's going to stop at this point. It may not be in an exchange. The venue may not, and in the United States does not have to be an exchange, but it provides an exchange-like functionality, which is transparency, the ability for people, investors to see lit prices, and for market makers to provide liquidity in that kind of environment. And I think you're going to start to see this evolution start to pick up pace. In the United States, you've seen Mary Jo White, our chairman of the SEC, come out recently in the last couple of weeks, actually, and say, I think the U.S. fixed income markets ought to have equity-like trading rules and transparency. So not only is the market driving in this direction, but you have the regulators pushing it as well to see this evolution take place.
Regulation, it's everywhere in the different asset classes we manage, we trade, we list. So let me switch to that aspect on the regulation and how that is particularly affecting the different time zones. But let me move to Europe. Robert, what can you tell us about MiFID II, a summary of MiFID II, and also what seems to be a new category of trading venues and execution venues?
Well, fortunately, for the time being, we are at the very early stages of MiFID II, which is what I call a new elephant in the room, because it will change, in fact, the way markets will functioning in Europe in the future. But here, let's limit the aspect to the fixed income market. Well, what MiFID II versus MiFID I introduces is a new category of venue, which is the OTFs, which is reserved to the fixed income market, and which is in fact comparable to MTFs, but as I said, limited to fixed income. And above all, you can discriminate between the users on this venue. Now, in theory, in fact, it sounds okay, but what else does it do? Well, it offers new possibilities in the future for market operators to operate venues which are more transparent to the market. At the same time, MiFID also clears the position of what we call systematic internalizer, in fact, under MiFID I, which was more bilateral venue, in fact, and now it has to move into the multilateral space. That means also that market making has to operate likely under the SI type of venue. Now, all of this might sound complicated. The aim is to create more transparency, especially more pre-trade transparency. But the question is, at the end of the day, will the market embrace these theoretical concepts? Will banks move that way? Will they operate market making under the SI regime? And I must say, in fact, having talked to many market operators, I have not seen anybody coming out of the bush yet and being clear on what they want to do, because the question is if you create transparency to the point where your likelihood of making money or creating sufficient traffic is not a given, then the question is, do you want to continue to invest in this type of platforms? And that's a big dilemma, in fact, for the banks for the time being. And I must say, when I'm also looking at the exchange world, we have a number of platforms in the market which are either buy-side or sell-side oriented or focused. Now, not later than yesterday, Euronext announced a new venue in cooperation with Algomi, after they had implemented the bond match platform only 5 years ago, and which, you must say, they're all nice concepts, but in fact, from a market push point of view, none of these platforms have really succeeded in getting off the ground. And the question that every exchange is probably asking these days, is this a priority for me? Is that the place where I want to invest money, where I want to invest in technology, where in fact at the same time you have enormous problems of bringing buy-side and sell-side to at least a minor common denominator, because at the end of the day it works only if the two sides are cooperating one way or another.
Yeah, that's quite interesting, and it seems to be also that the migration from the fixed income way of trading to a more like exchange-like traded model, it's not an easy one, and we will touch about it. But in that sense, Daniel, is an ecosystem of an all-to-all participants possible, or do you foresee that? There seems to be some platforms already out there offering that kind of access.
Well, you can't create a platform and expect people to show up. So I think if you're talking about changing things, you do have to change the ecosystem. And frankly, I don't think a dealer market has to be a negative thing. The positive aspects of a dealer market is the dealer knows the client and can price that knowledge into the price. So if it's a benign retail client, the retail client can benefit from the dealer knowing it's a benign retail client. What I think is critical to the ecosystem is the transparency of the trade and the price. So I think if we're going to see markets change, I think that you're going to need a broader changes. It can't just be creating a platform expecting people to show up. But I think if you look at fixed income in the U.S., credit fixed income, you see market access, which has gained a lot of traction, and then you have a few players like ours, KCG BondPoint, BondDesk TradeWeb, and TMC, and that is basically it. There's about 10 other platforms, but they don't really have any volume. So what will change this over time is people's desire to interact with different types of order flow rather than just interact directly with dealers. And the more transparency of the trading over time, the more real time it becomes, I think that desire will just grow. So I guess my response is the whole market itself has to change. The platforms are part of what can make it, can facilitate the change, but a lot of the changes really don't matter so much about the platform, it's more about the rules and the transparency.
On that issue, Donna, fixed income, and we discussed before, fixed income is a completely different market, especially when compared to a more traditional market that most of the people here knows, which is more like an equity-like or futures-like market when compared to. So how do we need to look at it? If as an exchange or an exchange operator can be successful in moving to that?
Well, let me share with you the experience that we've had in South Africa, Jorge, and it goes back to your first question and the second one you asked about regulation. In the case of South Africa, the development of an electronic trading platform for bonds was driven by regulation. The fact that in our Financial Markets Act, securities have to trade on an exchange. And when the project started in South Africa, the Johannesburg Stock Exchange was the only licensed exchange. It was not a desire from our National Treasury or for the primary dealers to go the exchange route. They much preferred to go directly to MTS or NASDAQ or one of the platforms already in existence because there's, as you can all imagine, this is a market that has grown up with very tight vested interests. And this new model that we're all talking about is a threat to some of those interests, and they don't really understand what it's going to mean for them. But where we eventually evolved to is the World Bank was a very strong advisor to National Treasury and has been pushing very hard for them to move to an electronic trading platform for all the reasons that we've been talking about in terms of the benefits. And the issue has really been to get the parties into a single place in terms of understanding what model will serve us best. And the issue has not been around the trading platform. We did an RFP, we found a trading platform, we found a very low-cost way to do it because most of the PDs were already connected to this trading platform. But the real question, and what this boils down to, is what is the roadmap you have in terms of evolution? And our desire is to go to an all-in market. So the issue is in phase one, it will be primary dealers only. Phase two will be primary dealers plus market makers. And phase three is intended to be the primary dealers, the market makers, and the buy side. But when you start thinking about how you bring everyone onto a single platform, you get into real questions about counterparty risk, clearing, assurance of settlement, and so forth. And even looking at a market of 9 primary dealers, that's where we're stuck right now, because even in the primary dealer world and in the global banking environment, we all know there are banks at the moment that are cutting lines to each other. So it's been quite an interesting challenge to get into the clearing and settlement space once we've crossed all the hurdles of how to get into the actual trading platform. That was the easy part, to be honest with you.
Yeah, that's quite challenging. And as a matter of fact, Eric, because you are in touch with the buy side and with the let's say with the customers. What are you hearing from your large customers about their concerns, not only on transparency and liquidity, of course, but also on potentially problems on who provides liquidity in these new venues?
Yeah, so one of the challenges from the buy side, particularly around fixed income and credit more specifically, is they find it very easy and would welcome the opportunity to transact in a transparent, agency, market maker driven type of marketplace for liquid securities. The issue that they have, however, is that if they give their on-the-run 10-year bonds, for example, to a platform like eSpeed or BrokerTec or some other model, they can no longer rely on the dealers to provide liquidity on the hard-to-trade securities. And so, to a certain extent, the dealers are holding them captive with this idea of, give me the easy-to-trade stuff. If you give me the easy-to-trade stuff, I'll continue to provide liquidity on the hard-to-trade stuff. But if you go to a different venue or you move that flow away from us, we don't get paid enough on the hard-to-trade stuff, and our balance sheet won't be available to you anymore. And so the very large buy side, certainly in the United States, is very worried about that dynamic. And it really is a barrier for them to embrace sort of new technology, new platforms, new transparency in that space. I also wanted to follow up briefly on a thing that Dan said, particularly again in the United States, so I think this is also true in Europe. What I would consider the post-trade infrastructure for the clearing of fixed income securities does not match the modern needs for the trading of fixed income securities. So the model that has been, certainly that's worked on in the United States, is that it's very expensive for liquidity providers to actually provide that liquidity and have that cleared in a central location. And there doesn't seem to be any real effort being done at this point to modernize that or accelerate that or look at that in a different way. And that friction, which Dan mentioned in his keynote speech, that friction on the system is a real impediment. There are countless numbers of liquidity providers who would be willing to make markets in these securities in the United States on various platforms and in various ways who cannot, because it becomes too expensive for them to clear the trade in a post-trade environment.
As I mentioned, we will talk a little bit about the post-trade needs and the post-trade environment, but let me first, with Robert, touch on could the liquidity dilemma be solved by executing in a central limit order book or in a, let's say, neutral third-party kind of exchange?
You can certainly improve to a certain extent liquidity, but provided that exchanges get supported by both the buy side and the sell side. And you know, in fact, all the examples that I see today in the market show very clearly that you are always lacking at least partially the support of one side. Now, why would, in a central limit order book or on the technology that exchanges in fact provide, do exchanges have any advantage over new entrants, new incumbents, which are leaner, meaner, in fact, who can act on new technologies, which are much more focused on certain segments? So what is the advantage that the exchanges have? And I must say, in fact, I have not come to clues yet. I think, in fact, we have solid, robust infrastructure to deliver, but nothing that really is focused enough in order to take care of new trading strategies, new protocols that are being introduced, and which you hear all over the place. The big danger I see, in fact, with all these new entrants to the market is that you create even more fragmentation going forward. And who says fragmentation says at the end of the day critical mass, and can you sustain a model like this? And maybe, in fact, there are other ways which we need to look at, but the exchanges are prepared to go that route, but I think we need to still fine-tune the models in order to really add value.
Yeah, Eric.
Jorge, if I could comment on that for a minute. In my career, I've worked at a large market-making firm, then I worked at an exchange, and now I work at an agency broker-dealer. And one of the things I've noted, and I often hear from exchanges, and I myself was guilty of it when I worked for an exchange, is we tend to view what we do as a higher priority in the world. And so we tend to view that as like if we build this and we invest in this technology, people will come and will trade here. And one of the things I've learned at the various stages of my career is that what makes these venues work is that people have to have an outcome in the success in the venue, right? It has to optimize the profitability of their activity, their needs. So for the buy side, can they find real prices and real liquidity? For market makers, can they make effective, profitable trades as a market maker? For an exchange, can they create a value prop for themselves? And if you don't get that ecosystem fully built, they don't work. And the exchange world and the trading world is littered with countless of these venues that have started that don't fulfill the need of you've got to make this work for all the market participants. So we can, in an ivory tower, build a construct that makes a lot of sense for trading fixed income, but people have to, it has to work for them, and they have to optimally profit from it in order for it to be successful.
Yes. Please, Donna.
Thank you. I just wanted to agree with the comments that have been made, and I think this is an opportunity for a lot of creativity on the part of exchanges, and that one can look at some of the infrastructures that are already out there, have the exchange be the operator of the market, and look at it on the basis of incremental cost and incremental pricing. And if you're migrating from a broker-dealer market to an ETP, as we are, that in effect saves enormous costs for the users, creates an incentive. In our case, we've got a primary dealer market, creates incentives for them to move their value traded from an OTC report-only market, which is what we have, because it's significantly cheaper. And you know, this is a volume game, and the volumes in this market are significant. So I think in terms of looking at the model, looking at the P&L opportunities, one has to look at scale, but it has to be built out in a creative way, thinking a bit out of the box, using what's already out there, and certainly not looking at it as a start from scratch. I think there's a lot of opportunity for partnerships and so forth that can create a lot of value in the market.
Yeah, because it seems to be that there's clearly an opportunity, although not necessarily under the traditional exchange model that we know. So this is where creativity and some other alternatives exchanges may explore to develop that market. And let me touch on something that is quite important, and even in my own experience in the emerging markets is extremely important, which is not the trading. The technology is there. It's a big challenge how to attract the players to actually buy and sell at that platform. But what about the clearing and settlement? This is where things get very, very complicated, not only in emerging markets, but seems to be, according to what you have been saying, Daniel, even in your papers on the market structure that is available at your website. How can you tell about the access to post-trade infrastructure, basically? That would be the question. The efficient access to more participants.
Well, I think you can tell often by who owns the post-trade infrastructure, who has access to it. But I think that in the case I mentioned before, treasuries, it's dominated by the primary dealers, really run FIC. But in equities in the U.S., it is a utility that, generally speaking, works pretty well and it's pretty easy. On the post-trade infrastructure on equity options in the U.S. is very interesting because it's decided to be basically a for-profit, and yet it's a monopoly. And so, and it's owned by the exchanges, and it's going to be interesting how that goes over time, but at least it's accessible to everyone. But I think a lot of times it is the tail wagging the dog. The post-trade infrastructure can really dictate how the market structure and the success and failures of various trading venues. And if the post-trade infrastructure doesn't keep up, or if the post-trade infrastructure is really complex and very expensive, it will impact the ability for people to buy and sell things on venues. So I think that's kind of self-evident, but it's definitely the case. European equities is very complicated. Post-trade infrastructure and futures exchange is very straightforward. Maybe a little bit of a vertical monopoly, but it's very straightforward. So I think it's critical. It's really hard to talk a lot about trading venues and understanding the changes that will take place without delving into post-trade.
It seems to be a critical issue because on the actual structure in many countries where you have an inter-dealer broker, but it's the execution takes place on a give-up basis, and then you go through this matrix of, okay, this guy can trade with this guy, but this other, they cannot trade with this other. That's very manual today. But in an electronic or more transparent trading venue, it seems that if you don't have a real efficient clearing and settlement pipes, that will be quite complex. I think you mentioned or you wrote something where that those who control settlement control trading. Yes. That's quite a...
I did write that.
That's quite a strong statement, but please, of course.
You know, when you're looking at the fixed income market, what you obviously need is in a very efficient derivatives market, very efficient collateral management. But when you're looking at the regulatory side of these markets, we have added additional layer of cost at the end of the day. So these markets have improved dramatically from a functioning point of view, but regulation, in fact, has not created, or at least has compensated part of the benefits that these efficiencies created. And that's where one of the problem, in fact, continues to have, which add an additional layer of cost to well-functioning fixed income markets.
In this sense, Donna, you mentioned to me about the development on a settlement insurance model that you are trying to develop in JSE. How does that work, and how is a model like that can be used to improve this post-trade activities, which is critical?
Thank you, Jorge. Well, you know, we've talked about, as you mentioned, trading, and you've quoted Dan in terms of the importance of settlement, but I have to say that this is the area that we have struggled with the most. And in the years that this project has been underway in South Africa, getting over the hurdle of trading, getting to grips with the roles and responsibilities of what National Treasury will do and what the primary dealers will do and what the role of the exchange will do and what the role of the CSD and so forth, all that we have landed very, very well and very nicely together as this coalition of the unwilling. But when it's come to settlement assurance is where we really have struggled. And this is not a matter of failed trades. We have worked out failed trade scenarios, and we've written a failed trade manual, and failed trades are not the issue. The issue is, what do you do in the case of a default? And in the case of the path that we are on, where the EGP is going to be first one of just the primary dealers, you have to have a situation where the primary dealers are happy to deal with each other. And even in that environment, we've got 9 primary dealers, 5 are local, 4 are foreign, and even in that environment, we're struggling to find common ground. The platform that we're looking to use that won the RFP is MTS. It's a European platform, trades a lot of European government bonds. And there are 2 ways to deal with settlement in that environment. One is anonymous trading and post-trade name give up, and the other is a full CCP. So we have found that the global banks that are members of our market, our primary dealers, are willing to go with either of those, but our local banks are not. And the local banks have come up with a proposal for settlement assurance that is one that is a hybrid that would involve putting initial margin to cover the market risk for the 3-day period between trade and settlement, to put that in the central bank as collateral. Now, that creates a lot of benefit for them because in terms of bankruptcy law in South Africa, it gives some certainty around the waterfall of risk and payout and actually benefits them on risk-weighted assets. So it could be that one of our challenges is that the banks are trying to solve all their problems and create a lot of benefit through this model and trying to get everything, including world peace. But it also it could be that we do end up with something very unique. The only issue that we have, and I share this with my fellow exchanges because it may be something that you face, is the global primary dealers are saying for them to do anything other than what has already been approved in existing markets, they need to get regulatory approval from their home country. And the home country regulators may not find this as innovative as we do in South Africa. So we're working on this now. One of the interesting points that has come up is the central bank saying, well, gee whiz, if I ring-fence collateral for this market, what does that mean for overall resolution in the banking sector per se? Will this somehow pollute or interfere with that? So we're having some very interesting debates, and I'm sure we're going to crack this, but it's really coming to the very core of where the risk is, where do you transfer the risk, and how do you clear some of this friction and create the most efficient market possible. So we're right in the thick of it right now, to be honest with you.
Well, that's but is this is a model, do you think, unique for your market, or is it exportable, or how it can work in the rest of the world? Or have you seen something like that in other parts, or you are developing for your own market?
We're developing it from our own market. I don't know of it in any other market. It's sort of a hybrid between a full CCP where you have initial margin and variation margin and so forth, which our participants felt was very expensive. They didn't want to go a full CCP route. We have clearing capability at the JSE. We could easily clear, but they felt that would be too expensive and perhaps not necessary in a club of 9. But on the other hand, they weren't willing to go straight to anonymous trading and post-trade name give-up. Yeah. So that's why we ended up in this halfway house. We still may end up in a further halfway house where we have this initial margin at the central bank and also have post-trade name give-up at end of day. So we're working with several hybrids. I'm hoping that we don't try to design a thoroughbred and end up with a camel, but we are, I think that, this is where participants have to do what works for their market, and where you think you can get the least amount of friction, the best level of risk management, and promote the most liquidity, because at the end of the day, there are huge benefits for bringing this trading onto an electronic platform. There's a cost savings for the market, and there's all the benefits that Dan presented in his presentation, plus the issuer themselves really want to see this happen. So they're creating incentives for the PDs as well to put more trade on. I think that's the answer to your question, Dan. Do you create a platform and see who shows up? In our case, you create the platform and you get the issuer to get the primary dealers to use the platform. Otherwise, you do end up in this situation where you could have huge investments in technology and have a beautiful system that nobody uses.
And there is little doubt about the importance of the dealers in this shift of microstructure, and the fact that they have a lot to say on the post-trading side as well. But let me just go back a little with Eric on the buy side. If again, mentioning the numbers we saw at the beginning of the shift of the inventories from the dealers to the buy side. So it seems to me that the buy side has a lot to say, or at least ideally, they should be able to say a lot on where, how they will be able to trade, because obviously for them it's extremely important for compliance, market transparency, price discovery, to have a better, or what it seems to be after all what we have been discussing here, a most efficient or a more efficient market structure. What can you say a little bit more on the buy side?
I think one of the things that we've seen in the United States, and you've seen some of this globally as well, is the buy side clearly feels the need for more transparency, more liquidity, and more access to prices for a whole variety of securities. To the point in the United States that they have invested themselves in various different platforms to try to make that happen. So in fixed income and credit, the most startling one was when BlackRock came forward with this idea of building Aladdin, which was a trading system for buy-side only to trade corporate credit in the United States among themselves. One of the interesting things that happened with that is no one showed up. And we've seen that experience in equities in the United States as well. They invested in a dark pool called Luminex, and no one has shown up for that as well. And so they clearly, the buy side has an urgency or a need to have better sources of liquidity, more transparency, more access to different pools of liquidity. But in trying to do it by themselves, they've shown a great deal of lack of success in doing that. These models just don't work because, in my opinion, they're missing a key ingredient in that, which is where's the liquidity come from? It's a little bit of a joke in the buy-side community, but if one guy likes one security, all buy-side guys like the same security, and they all go the same way at the same time, and no one gets any trades done because everybody wants to buy the same security and no one wants to sell it. And that's what market makers, that's what liquidity providers, that's what venues provide to the marketplace is that liquidity, that ability to bridge people's desires to trade. And so the buy side's eager for solutions here. They just haven't seen or felt one that they get traction with.
Okay, so let me turn now to the audience. I'm sure that after the great party yesterday night, everybody is eager to ask many, many questions today. So please feel free to ask any questions you may have. Great, we have one. I like always to start with the second question because the first one is always tough. So. Thank you.
Very interesting panel, thank you. The quick question, which was not covered, the ETF and basically concentrated the liquidity in non-liquid bond issues. So if you could elaborate a little bit on that, how you develop liquidity in non-liquid type of fixed income instruments.
So on the ETF space, that's an excellent question. So ETFs and particularly fixed income ETFs in the United States have grown tremendously. To a certain extent, they've pushed the problem just downfield. So, the market makers who trade fixed income ETFs actually have to buy the bonds in the marketplace. So in some ways, you've just transferred the liquidity problem from, one market to another by doing that. One of the things that's fascinating to me, though, about the ETF space and fixed income in the United States is the treatment of the securities is different from a capital point of view, from a settlement point of view, and so you can, in fact, engage in a little bit of regulatory arbitrage if you know what you're doing, because it's easier to finance an ETF than it is a basket of illiquid fixed income securities. And so what you often see is people going into the ETF because they can actually take that out in the marketplace and finance that, where they couldn't necessarily finance the actually underlying bonds. It's an irony, but there's a regulatory arb built into the system.
And I'd like to add a couple things. I think it's a great example of how the market ecosystem in the equity market functions well and the high yield market doesn't function at all. And some of it is the ability to finance, some of it's the ability to clear, the fact that an ETF is transparent, you know the price, you can buy and sell at. If you look at an ETF like J&K or SJ&K and compare the bid-ask spread of the ETF to the bid-ask spread of the basket of bonds, it's about 10% of the bid-ask of the basket of bonds. And while it's true that ETF desks may, from time to time, buy the baskets, create and redeem, but also from time to time, they may trade SJ&K versus J&K versus something else. And when they're doing that, they're creating liquidity in the ETF that's independent of the basket. And so I think it's probably one of the best examples of why market structure really matters, that the ETF market is giving access to people to trade things they wouldn't be able to trade otherwise or be comfortable trading otherwise. And ETFs in general are about to hit 3 trillion, and a lot of people think they're going to 5 trillion by 2020. So I feel like part of their success really has a lot to do with the transparency that the equity markets in the US, that they're largely considered equity market products. That's part of the reason they've grown so fast.
Thank you, excellent questions. Please, we have another question here.
Hi, Mohsin Mustafa from Qatar Exchange. First of all, I want to thank the panel for such a thought-provoking discussion. And while I'm in that state, I just wanted to have a reflection. I think there's been a lot of discussion on the secondary market liquidity. But if we take a step back and try to do comparisons between the fixed income market and the equities market, I think the fundamental difference is also in the primary market, where you would have a Facebook or a Google IPOing to a public with a mandatory public offering from regulators and all that. But in a fixed income market, there is no IPO per se, and you would have primary dealers, a handful of people who would hold inventory, and then there you go. I mean, there's no incentive for them to have more liquid market. They would trade with the institutional clients with lack of price transparency, and they have incentive to keep it that way, because to the point that Eric was making, the buy side is becoming more and more hungry for transparency. So could there be a push from the regulators and buy side that we will only subscribe to bonds or invest in bonds where there is free float, for example? I mean, in equities, institutional clients won't invest in equities where there's less free float. So if we start drawing comparisons, can we just change the structure at the primary market?
You want to comment, Robert, on that?
I could add to the first part of the question, the international primary market. In fact, what's interesting, one of the problems of the liquidity is the huge diversity of the universe of bonds which we currently see. And the International Capital Market Association is currently working on a study, which I find very interesting, about how to standardize more the primary market. And that means, in fact, moving to much bigger issues, maybe, in fact, 1 or 2 lines per borrower only, over different maturity ranges, but in fact, simply reducing the scope of the offer in the first place. And that would create more critical mass, and obviously, in fact, would enhance liquidity on that side. It's a theoretical development for the time being, because markets function a little bit differently today, but it's certainly an interesting way to look at.
Okay, so let me ask one quick question to my panelists, but you need to say only A, B, C, or D, okay? You need to choose one. And it's about, we talk about the different potential models, exchanges, ATSs, or new structures to appear in Europe soon. But what seems to be the model of a market that may be working the best in the future for the migration of the fixed income market to a more electronic and transparent trading environment? Is A, an RFQ, B, central limit order book, C, a dark pool or block trade functionality, D, something else? Daniel.
D.
Donna.
Well, I say D as well, and I'd like to say that D, qualified by there is definitely a role for exchanges here, and if I can use an analogy from Africa, at African weddings, you don't get invited. but you are expected to show up and dance like you did last night. So I encourage the exchanges to show up at this wedding, because if you don't, it's going to be A, B, or C, and it won't be D, and I'd like to see it be D, because I think we have a lot of value to add in this.
Thank you. Robert.
A, B, and C have not provided the answer to the solution in the market, so
Yeah.
for me it's D very clearly too.
D as well.
Well, that means that we have a lot of work to do in the future, because there's going to be something else. Hopefully we can discuss that next year. So please join me in giving a round of applause to my colleagues. Thank you very much.
Thank you. We're going to start with our next panel now. Our next panel is titled Exchange Linkages, the New Paradigm, and how appropriate to have it here in Colombia, the birthplace of the last successful exchange linkage project. Here to talk about it all, our moderator, Francis Stenning, one of the pioneers of exchange linkages in the region. And we're delighted to have Mr. Hernandez, who is the regulator of Financial Superintendence of Colombia, To his right, we have Oscar Onyema, the Chief Executive of the Nigerian Stock Exchange. To Francis's left, we have Dr. Kubo, Executive Vice President of the Shanghai Stock Exchange. And finally, to my immediate right, we have Tajuddin Atan. It feels wrong not to call you Dato, who is CEO of Bursa, Malaysia. So we have a great representation of exchange linkage projects around the world, and we look forward to hearing from all of you as to why now and why this makes sense.
Okay. Good morning, everyone. Nandini, thank you very much. Thank you very much to the World Federation for the invitation, and thank you to Bolsa de Valores de Colombia for also the opportunity. We are here to discuss something, a topic that I think is of interest of pretty much everyone, I think, in this room. I think we have all, at some point in time in our exchanges, discussed the possibility of linkages with someone else, of integration initiatives also. So I think that, again, we have gone through that exercise internally, and some of us have taken this step towards working in some linkages around the world. I'm part of one, as well as Gerardo, who is joining me here in the panel too. We have worked together in developing MILA, the regional experience here in Latin America, together with another experience also in Central America. El Salvador and Panama have also started working on some integration in the region. So again, I feel part also of this exercise of working and have experienced the initial dynamics of what an integration or the linkages mean for some of us and some of the, and I think that I will also contribute with my experience on discussing what the challenges are and what difficulties we have found through the process. But again, we have representatives from pretty much around the world here. We have Malaysia representing the Asian initiative with close to 7 stock exchanges joining the effort. China, also experiencing a different type of linkage with something more looking towards the local market versus the foreign market, but I think it will be interesting to hear from him the motivations. And then we also have a representative from the Nigerian exchange who is also, I mean, they're the pioneers or the first ones in implementing the West African initiative of integrating its four exchanges for 4 exchanges so far. So I think the best way to start is to probably ask each one of us or each one of the panelists to explain us, or to at least if they can briefly talk about what were the motivations for them to really start the process of linkages. So I will start with in my left with the Asian experience, and Tajuddin.
Thank you very much. First and foremost, let me record my thanks to Juan Pablo and the Bolsa Colombia for having a fantastic and organizing a fantastic conference, and Nandini for allowing me to be part of the panel. I think initially the value proposition is what we are looking at. 7 exchanges, 6 countries, more than 3,000 listed companies, market cap of over $2 trillion US, and more than 600 million people. I think this seems to be a lot of potential, a gathering of countries. If we were to gyrate within the center of ASEAN, the traveling time among these cities are not more than 3 hours. So what we have here is a growth potential out of ASEAN and individually growing at a certain pace. The question that backs us at that point in time here is that, what do we have in ASEAN? Interestingly enough, in ASEAN collaboration, there is a diverse group of people. Diverse exchanges from a developed exchange, advanced emerging category, and even up to the frontier category. So what we're saying here is that individually, it has its own value, it has its own purpose, it has its own mandate. But as an ASEAN growth environment, with GDP growth of high or mid single digit, we are saying that ASEAN decade growth would be beneficial for us if we were to work together. So hence the reason why we felt that ASEAN collaboration, if you may call it, or ASEAN leakages, as the topic may say, indicate that we have a value proposition to sell it from two perspectives. One, as an ASEAN, as an asset class by itself, for ASEAN perspective, and secondly, to actually increase or allow cross-border trade. Let me stop there for the time.
Okay, just one more. How long has the initiative been in place, or just so that we kind of understand how long this process can take? I mean,
okay, all right. In the case of ASEAN, it is not an exchange initiative initially. It started with a policy by the ASEAN ACMF, this ASEAN Community Capital Market Forum in 2009. Okay. Subsequently, the ASEAN Economic Community subsequently agreed by the finance ministers to say that we should get together to do that. So the link, the ASEAN collaboration took off in 2011. So the policy was 2009, we get together to 2011, and subsequently the link that we established as one of the project was established in 2012.
Okay. Let me go to Oscar first, because it's an initiative that I think is very similar to the one in Asian. If you can briefly also give us what were the motivations and the expectations when you started this project, and when did you start it in Asia?
Thank you very much. I would start by thanking Juan Pablo and Nandini for organizing such a great conference and for inviting me to participate in this discussion. For us in the ECOWAS region, it was a directive from the heads of states, members of ECOWAS, as part of the integration, economic integration of the entire West African region. The effort started about 10 years ago, and this current effort that we are doing actually started in 2013 to help to actualize a few things: cross-border trading, and the ability to raise capital across the entire West African region. The rationale being that you can do more trade with the combined population of 290 million people. You can have better liquidity if you were to aggregate all of the 13 countries. There are 4 exchanges, but 13 countries participating in this effort. So we have had great traction because of the support of ECOWAS in addressing some of the issues we'll be discussing.
Bo, in the case of China, it's a different type of approach. It's basically you have a local versus foreign market. Or I mean, can you explain us a little bit about the process or the linkages that you're developing?
Okay. Good morning, everyone. I think China is a big country, and we developed the economic for more than 30 years. But China capital market founded at early of the 90s. But from the very beginning of our market established, I mean, obviously the capital market will look for the outside because we are emerging market. A lot of new developed market already there, and they have experiences. So from the very early beginning, I think it's in 1992, we issue a B shares that dominated the US dollar, can let the foreign investor touch the local, very, very small, very new market. And in China, we got mainland, we got 6, exchanges. Shanghai Stock Exchange, the main board, and Shenzhen Stock Exchange focus on some small and medium companies. We also have for commodity exchanges. And I think when the market grew rapidly, it is a nature need to support our listed companies to look outside, develop international business, help them financing, issue some bonds and stocks, develop business overseas. And I think also for China, it is unique, the investor structure. So many individual investors. So we have, as an organization of the stock exchange, we have aim to improve our investor structures, that develop more institutional investors and introduce more international. So I think around 2002, we introduced such of QFI systems, qualified foreign institutional investors, and open our market more open to the outside world. And it's good, I think it's good. Afterwards, we introduced RQFI, use the offshore IMB to invest domestic market. We also introduced QD, that the local investors can touch the outside world. And in the recent years, we accelerate our international, step fastly. In 2014, we launched our first Stock Connect with Hong Kong Stock Exchange. And I think it's a development gradually. According to WFE's ranking, Shanghai Exchange already a big one. It's ranked 4, I think, or 5 market capitalization. And for IPO turnover, it is more bigger, ranked 2 or 3. So it's a great country, developed very fast, and the capital market naturally to open outside to the world. So we have these motivations to develop, but anyway, it's a step by step. Okay.
Thank you very much. Well, let's take the view from Gerardo. He's again a regulator in the Colombian market. We both participate from the MILA project. But I'll first ask you the question, Gerardo, in terms of what's the view from the regulator's point of view of these linkages or integration initiatives? How much, where do you see the value from the perspective of the regulator and from the market in general?
Thank you, Francis, and I want to thank the organizers for a very good conference and for a delicious meal yesterday and fantastic music. But now I'm feeling a little bit lonely in this panel. I'm the only regulator. I don't know if I'm the only regulator in this room, but I'm going to try to say something about the issue that has pointed out Francis. Maybe you remember that 6 years ago, we launched officially MILA in Lima. And it's interesting because MILA began like a private initiative of the exchanges, of integration of exchanges. But what has happened is that really MILA gave us the opportunity to open the door to see financial integration between Mexico, Chile, Peru, and Colombia. So we are now talking not only of trading, but we are talking of really try to find a financial integration between the countries. Yesterday, in one of the panels, it was said that regulators always like to say no, but it was not in this case. In this case, since the beginning, we've been working together with the industry. We believe that integration, financial integration, integration of markets, of exchanges, give us enormous opportunity for the development of our market, Colombian market, as well as the countries of the Pacific Alliance. And taking that in mind, we have worked continuously to try to help this process go through. You have to have patience. We've been working a lot with regulators of the other countries. There is needed a lot of confidence, of trust, but I think that in the way we've been moving, we've been taking step by step, and as I say, I think it's an enormous opportunity for us to work together and to have not only the integration of exchanges, but a real financial integration.
Thanks, Gerardo. Yes, and I have to recognize the effort that we received in MILA when we started working was tremendous from the regulator's point of view. It was crucial for the success, and I probably have to point out that it was not just the exchanges and the regulators, but also these central securities depositories, or all the 9 participants, no? 3 exchanges at that time. Later on, Mexico joined us. But the 3 exchanges, the 3 CSDs, and the 3 regulators really had a very good joint effort in putting this together. But I wanted to add a couple of things regarding MILA, no? And I think the motivations for MILA were definitely looking for in the region for more diversity of opportunities for everyone, not just the supply, but the demand in the market. We looked at lowering costs as an opportunity, let's say, in trying to link exchanges to save some cost in people moving from one market to the other one. We looked at as a way of adding value to our participants by joining them through the region. When they started becoming regional, then we thought that, again, yes, by us linking and offering more of an integrated platform, there was also a way of adding value to the whole process and to joining the effort, to contributing to the market. Those were for us, some of the key elements that drove us to developing MILA, and I think we have been successful at that. But there is the one primary issue that I think drove us all, and I think we have not been probably some of us sincere enough or clear enough at the time of mentioning what were the key motivations, and it's liquidity. No, the concern about liquidity in our market was a driving force for us to start thinking about integrating our markets. No, I mean, there were these forces coming from the most developed countries. There was this globalization of the markets, also allowing issuers to go somewhere else and not thinking about local markets. And so I would like to probably go around also again with the 4 of you on seeing if that's something that you perceived and that's something that you have accomplished in so far in the effort of integrating. Was liquidity an issue when you start thinking, and has the linkages responded to it? In your case,
let me take a step back about just one quick comment. I like what Mr. Hernandez was talking about, initiative and push by the regulators or policymakers with regard to collaboration. I think you started MILA as a private initiative. But in the case of ASEAN, we need to recognize this, that it is a initiative that have got a governmental policy push. Right from the very beginning, where there is this ASEAN Capital Market Forum that pushed that into place, and subsequently there is a blueprint. So what we recognize in that blueprint here is that each exchange or each country will participate at the state at which they are ready. The level of readiness and ability to meet the requirement of the respective framework is the essence of an ASEAN collaboration. So when you recognize that, you will recognize one thing, that there is different state of development among the members. So when we go to that level, we will realize that only those who reach a certain level of development or trading would most probably participate in the initial ASEAN collaboration or linkage in this particular instance. So in this case, in the ASEAN linkage environment, 3 exchanges are very much in the driving seat on this. That's Singapore, Thailand, and Malaysia. So having said that, there is this trading on 2 aspects. One, the existing infrastructure that is in existence within ASEAN, at which the proximity between one city to another during about the same time zone, at the most 1 hour or so, having that already existing trade. That liquidity for purpose of traditional trade is already going on. On the second aspect, the price, the increase in liquidity through the effort of the ASEAN linkages is something that is quite new. Generally, why we're trying to emphasize here is that while we have an existing trade that is going on, bringing in those who are not ready, bringing brokers that are smaller in size to connect within ASEAN is the premise of this linkage to actually increase liquidity. That second part is a little bit more challenging. To a certain extent, it goes back to the blueprint that we are talking about. So I think the issue of increasing liquidity not only covers the private initiative between the ASEAN exchanges, but also requires the push from all other stakeholders to actually bring this to that particular point. Currently, I think just to summarize this point, that the ASEAN exchanges are really looking at the modality of the current linkage to see how better this link could actually benefit both the retailers and the institutional participants within ASEAN, so that the intention of having cross-border trade should increase within ASEAN itself. And of course, the second one is to actually allow and attract outside or trade from outside ASEAN to actually participate and provide more liquidity within ASEAN. Generally, the objective is still trying to attract more funds or investors within ASEAN as the main objective.
Thank you very much, Tajuddin. Let me go to Oscar again. And liquidity an issue? Has that been? Have you seen any progress in that sense in your project?
Certainly, liquidity was at the back of our minds, but I would like to take a step back and give a little more color on the West African capital market integration effort. So you have the ECOWAS heads of states saying they would like to integrate and have something like the Eurozone. But it was left to the different financial systems to figure out what they wanted to do. So in the capital markets, the exchanges, the regulators, the CSDs, we got the banking system involved, got together and figured out how to be able to do cross-border trading. The overriding objectives were really to facilitate capital raising across border and to allow the brokerage industry to be able to trade across border, and in so doing, bring in a lot of the people that are excluded, because you also have to consider the level of development in West Africa. So it was really more about financial inclusion. It was more about giving countries that do not have exchanges an opportunity to have access to markets. So while it was 4 exchanges, Nigeria, Ghana, BRVM, and Cape Verde, we were covering the entire West African region. So liquidity was, at the back of our minds, but it wasn't the overriding factor.
Okay, thanks. Okay. How about in the case of China?
In China, everyone knows liquidity is not a problem in our market. It is not a problem at all because so high liquidity in China capital market. But I think our stock exchange, among our colleagues in China exchange, we do our development for international business. I think the main reason is, first of all, you see China as a big, developing country. It encounters a lot of temporary questions now. We are just restructuring our economic, the development path. And we will let the RMB, our local currency, become more international. And I think a lot of Chinese traditional companies need to improve their business model. Also, we just had mentioned of the local investors, we try to increase our structure of investors. So those are the need, very, very big need. I can say it's a reform. It's a reform. So for the stock exchange, I think it can play more important role to help the country to realize this reform in the future. We've got a lot of tasks in front of us. But when we focus on the international business development, One thing, our colleague, we do a lot of research, look at the other successful stories, Milan, the ASEAN, or some developed exchange. We found it's very interesting that because China is still a capital control country, so we definitely will open our market gradually. So one thing is very interesting. You see for the exchange industry, the mutualization happened, I mean, a few years ago, 10 or 5 years ago. There were a lot of, merger and acquisition. But when we launch our Shanghai Hong Kong Stock Connect, we see some advantage of ITs. We see a lot of new things happen. It is possible for us not let our brokers, not let the financial institutions to do this international business, expand their overseas business by on behalf of their clients. Actually, in fact, as an organization, as a very infrastructure supply, a stock exchange can play such an efficient, organizing this business. So this is a very interesting things we found. So if you look if the exchange to organize this international business, it is more high efficient and a low cost. And if we have a successful discussion with our brokers and the investors, I think we truly find some solutions to develop some. We can pick some small, initial step project like Shanghai Hong Kong stock. We not do open our market totally. We just pick some of the stocks can be traded across the board. Next step, maybe we can put more funds, more stocks, more ETFs into this project. When we look at China trade relationship with Europe region, we found a lot of, actually our listing companies do a lot of business, between China and Europe. So we think we can discuss with our partnership, our friends in Europe room. So we set up some joint venture with Deutsche Börse last year. It's a joint venture exactly according to the German law, European law. It will be easy for the local guys can buy some maybe products in Europe. So this is the way we think that actually the stock exchange can play a more important role to organize these cross-border transactions. Yeah.
If we go back to the Colombian case and from the regulator point of view, again, if liquidity was an issue or it wasn't an issue, I do believe it was for all of us, but if it was not, where did you see the most value added from linkages and from the integration process from your perspective?
Yes, I think that something that it's very important to remind to the public is that the countries that began with MILA and that now with Mexico are in a more trade and more bigger project from support by the government have similar characteristics that they facilitate the process. First of all, there are countries that are well known to have managed macroeconomic in a good way. In a second point, the markets are in some way they complement what it's produced, or the issuers of some of the countries are not in the other countries. So if we see an integrated market, we really have more issuers, more liquidity, more trading, more possibility of diversification for the investors. And in many ways, we have similar regulation and supervision activities. And that's what we've been looking together with regulators of the different countries. So when you sum up, when you add all these characteristics, you have a good case of possibilities of exit, because markets complement and the different countries acknowledge that our markets as a whole are very small, but if we complement our markets, we can have a potential and benefits for finance and for development of our countries. So in many ways, I think that liquidity could be an issue, but it's far away more than liquidity, what we are looking for, and that's why we've been supporting since the beginning the process of MILA and looking for a bigger financial integration between the four countries.
Well, but yes, I do agree. I mean, probably liquidity is something that triggers at least the interest for exploring opportunities, and linkages being one of them that has many other value-added reasons, you know, around it. But let me follow that question with the next one and start with you, Gerardo, too. But in this case, just to see what are the challenges as we go forward. We've talked about what are the benefits of probably going into an integration process. But as we look forward, where you see the major challenges of MILA, and again from the regulator's perspective?
Yeah, I think that the main challenges right now, we have a very big challenge, and it's try to have a more openness for some of the financial instruments to be negotiated and trade between the countries. And also with taxing, try to have a more homogeneous framework of taxes in the different countries. And that's why in my first intervention, I said that we have to have focus, have patience, have perseverance. Otherwise, we are not going to be able to get to the point that we need. As regulators, we've done a very good work trying to have a more knowledge of our regulation in the different countries, of the supervisory practices. What we found is that regulation, financial regulation, is very similar, that our supervisory practices are similar. Those practices are giving us more confidence of the way supervision is done in all the countries. And in that way, we have a very big step towards possibilities of following financial integration. But right now, I think that we need, as someone said here, a bigger push from the governments in a more general way, because it's not only a problem of financial regulators, but also it's becoming a more geopolitical concern. And in that way, I think that the last meeting of the Ministers of Finance of the Pacific Alliance, in which they supported financial integration and asked for more work on that behalf, it's very important. But when you see more at a micro level, there are issues related mainly with taxes, some related with more trading procedures. But I do believe that if there is we have a real opportunity of going forward and going over those obstacles and challenges.
I can probably add to all what Gerardo has mentioned, and knowing MILA closely, I think that something was mentioned also in the previous panel, no, is trying to evolve the ecosystem also within the process. No, I think that it's not enough with just building the infrastructures and waiting for business to come. I think involving the institutional investors, involving the custodians, involving even, again, the international institutional investors in the whole process on acting the way that we believe should be acting within our infrastructure. No? So again, I think that, I agree completely and added that one more aspect. Oscar, in the case of West Africa, again, where you see the most challenges in the process?
Well, I can think about it from two perspectives, challenges going forward and challenges we faced to get here. There are some obvious ones, language. So within the region, you have people speaking English, French, Portuguese. And so the first major debate was, what language are we going to? And we sorted that out by saying, keep your own language. The second question was, what currency are we going to use? Because there are different currencies. And we sorted it out by saying, keep your own currency. And in that case, keep your own order book as well. So the implementation is really in 3 phases. The first phase being direct market access, where you're sponsored by a domestic broker into the market. And then the second phase, again, we're in different stages of development. So we had to come up with minimum standards in terms of law, taxes, and the rest of it. So the second phase is brokers that meet the minimum standards can then have access the markets directly, and that was the qualified West African brokers, which means you have a passport to access the market. And then the third phase is the West African securities market, which is a cloud that allows you to access everywhere and also raise capital across the region. So the challenges were from very simple things like what order book are we going to use, to more complex things like infrastructure, payment systems, clearing, how do you move money and security across borders. And we sorted that out by having what we called an international CSD, which is just a mirror of the domestic CSDs, and kept a log, if you will, of all the transactions. So you were not actually moving security across border, and you were only netting cash and moving cash using settlement banks, not central bank money. So those things kind of helped us address a number of the challenges that came up in the discussions. The last thing I'll say is that because the regulators were in the room, the CSDs were in the room, the exchanges were in the room, the central bankers were in the room, we were able to address a number of the issues relatively quickly. So listing standards, trading, market structure, and things like that really went fast. Now, there are certain things we could not change. So company law, for example, the various laws in the various countries, we had to work around them while people, in the short term, while people are trying to address the laws to meet minimum standards that we've set. And we're benchmarking ourselves against international standards so that we could be attractive to the foreign investors. Now, going forward, we've had, we've completed phase 1. We've had trades between Nigeria and Ghana, for example. But going forward, the challenges we face are actually political. So while the English-speaking countries seem to have moved on, the French-speaking countries, because of the way their political system is, where they have to actually get ministerial approval to do a few of the things, and they have about 11 countries that have to make decisions, it's kind of slowed down the process. So that's the first challenge. Second challenge is with the regulators, right? So they decided that they would move out of the group, form their own group, and have us submit rules for approval, which means that they're not in the room when you're forming subsequent rules. So the approval process for the new rules might be challenged because they have not had the benefit of being on the table as when we did phase 1 and the rules were easily approved. So those are two major challenges that we see going forward as we move into phase 2 implementation.
Tajuddin, in the case of Asian,
the challenges.
I mean, how the challenges that you have faced, any difference than the ones we have already seen in the other markets? I mean, having 7 countries, exchange rate, for example, is that probably the issue?
I think it's quite summarized by some other panelists. But let's look at the modality at which we operate. Like I said earlier, in the ASEAN environment, there is different stage of development. Initial modality, business modality, was to look at it from a multilateral perspective. Let's assume that everybody can come on board, and when they are ready, they should come on board. I think it'll take a long while before everybody is ready. Because as you understand different stage of development, those who are developed will continue to grow and develop further. So hence the reason there's two sections of this ASEAN collaboration. One that require a little bit of help or collaboration from not the trading side, not from the post-trade type, but more of developing to achieve a certain level of trading or environment to be part of this big picture. So hence the reason now, after a while, the ASEAN exchanges is thinking that, is there a need to review the business modality in the ASEAN linkage or ASEAN collaboration to bring up to speed everybody? So one of the thinking that comes in here is that we should recognize two things. One, we should recognize the existing infrastructure as part of the collaboration, taking in all what is existing. In essence, for instance, between Malaysia and Malaysia and Singapore, it has been a trading partner for the longest time, even before we initiate this. So the trade volume between Malaysia and Singapore continue to increase or decrease depending on the value proposition or market condition. That's a given, all right? I like your comment about the language, despite we being very long neighbors and very good neighbors. Kun Kasara from Thailand is a good friend of mine. I think that the people from Thailand, somehow or other do not have access to the research report that is produced in Malaysia, for instance, which primarily are in English. While the value proposition, the value that indicate that the research shows that these are good companies that need to be acquired or to be traded, are left behind. So these are the basic issues we are looking at. In short, what I'm trying to look at here is that the modality covers one, existing infrastructure that we need to embrace. Secondly, we are saying that should the collaboration look at bilateral among the exchanges, which means to say you recognize bilateral between bilateral and subsequently deal the multilateral. Otherwise, you will see when you want to put everybody on the same space, on the same platform, the pace of growth or development will be slow. So if we can actually recognize that and tell among ourselves and be honest among ourselves to say that realistically, if Thailand and Malaysia, for instance, since Kun Kasara is in hall, in between the two of us, can we progress? But not, looking at the other partners to saying that we are not leaving you behind. So this part, once we recognize it's bilateral, require us to say, what else can be done? So it goes back to the easy question. Easy question is that what the exchanges can do among ourselves. These are business modality, product. You asked about liquidity just now. I didn't quite answer about liquidity. I answered you about liquidity on existing basis. But to increase liquidity, there's products. Products like ETF that is still far lacking in ASEAN that could generally increase liquidity. But if it were to be done on a multilateral basis, it will take a little bit longer time. But if we were to be done between bilateral basis, you will see that Malaysia and Singapore, Malaysia and Thailand, Malaysia and Philippines can actually cover that. And you'll see increase in volume, trading, and addressing some of the challenges. Part one. Second part, obviously, there is, I will not repeat the point where we have a regulator matters that need to be looked at from a harmonization of policies and of course the policy. The setting I gave earlier about policy here is that in the case of ASEAN, there is this ASEAN Capital Market Forum, of which the blueprint under AEC, ASEAN Economic Community, have a clear deliverables on a certain period of time at which we should achieve that. Obviously, there is, of course, some reflection that require us to re-look at the KPI, but those are the three challenges that actually need to be addressed to move this ASEAN collaboration or ASEAN linkage to the next level. We have policy, we have regulator, and we have the exchange initiative.
Okay. Thank you very much. Both the challenges, but before both, I would like to open the floor for questions from the audience after both interventions. So if you can raise your hand, and we can start at least planning your question. Yes, which are the challenges that you see for further integration or linkages in China?
I think the challenge is, it's a big concern when we develop such a cross-border, link programs. I just remember there are so many, so many challenges when we first want to have this idea. Because I heard after 2 years, the Shanghai Hong Kong stock, function very well. But still, I heard some of our friends discuss with me and told me, your story is a unique story because you see, Shanghai, Hong Kong in the same time zone, and you have so many, same companies both listed in your stock exchange and the Hong Kong stock exchange. You have the same language, so it's easy, very easy to launch such a program. But I have to say, when we had this idea at first, still meet a lot of challenges because you see, Shanghai Stock Exchange obviously it's developing, market, but Hong Kong is relatively more developed. The legal system, the regulatory system, totally different, and the institution of the members, different. So just I mentioned the investor structure are different. So you can see, the value of this same company, same stocks are different, so different. So still, it's not so easy, a story, easy project. We face a lot of, the rules problems and the IT. IT is definitely. Because in Shanghai Stock Exchange, you see the trading system, it's a huge, we also have an ID system. I think it is only Shanghai and Shenzhen, the Chinese domestic have an ID system. I think a lot of other exchanges, they don't have such ID systems. Also, you mentioned the regulatory, problems. I think it's definitely a tough questions because the attitude of the regulator is so important, so important. And I think the challenge not only covers the preparing for or launch for this project, but also after we launched, we still look after these functions, look after these connection systems. We will pay constantly review, constantly, feedback of these functions. Some questions still there, I can say. Some questions still there. So we will pay more attention, pay very cautious attitude to develop those, link projects. One question maybe is the regulator for concern. It's a cross-border enforcement. Right. Yeah, enforcement is very important because in domestic we have an ID system, but in Hong Kong they don't have such. So this is a problem. Also, we got some protection of investors. The requirement maybe not so at the same level. Also, the information, the research report can easily get. So when we developed the Shanghai Hong Kong Connected, we call it the version 1. We were version 2. And I think when we develop such a joint venture in Frankfurt, it's more challenges. Language, yes, legal systems. So I think these all very, very important things we will pay more attention to. But good news is after we launched this Hong Kong Shanghai Connected, I see a good news is I see the two regulators. They have more dialogues, more discuss. They can know each other. Yeah, more frequently, more meetings. So it's good. It's good. So I think for IOSCO, this is another important organizations. We can, as a member of WFE, we can give the suggestion to ISCO community, because you can see more and more stock connected maybe happen in the future. So I think the regulator, they had to discuss this project, set some basic principles to cover this, stock connecting. It is good for the business in the future.
Good. We'll have IOSCO later today in one of the panels. So you'll be, yes, we have a question over here.
Thank you. My name is Graham Sinclair from Ceres. I'm working with $15 trillion of institutional investors to promote sustainability in stock exchanges, helping stock exchanges cover some of the weakness around listings and environment, social, and governance factors. I have two questions, one hard, one very easy. In the panel, and congratulations, this is an excellent panel. I wish this could run for 2 hours. The point is made, linkages versus M&A. And I would love 5 answers, including from you, Mr. Moderator, to a very easy question. And the question is, would you rather be linked or would you rather buy or sell yourself?
I was saving that question for the end, but that's
fair enough.
Welcome to
and then the very serious question, the very tough question, which I would appreciate 5 answers on, but I know Oscar would have a very good answer on this, is in the serious business of football, when Ghana plays Nigeria, how do you handle this crisis in your forum and in your meetings? This is very serious. I must know the answer, please.
I think the linkage versus M&A is a very interesting question, and I would like everyone to comment on that one as a way of whether it adds value to the whole process, or is it an alternative, or is it the next step in the process of further integration among countries, exchanges, or related to all these value added that we see on linkages, if that's a way to really further increase the value that they create. So, first you, Tajuddin, do you see M&As?
Let me try to take a bite at that. M&A allows a disruptive approach.
Okay.
So you will have one polarity of having an M&A where it requires all parties to actually move towards a direction at which you wanted to achieve an objective. That's disruptive. In an alliance environment at which you have many parties around, you have to actually gather everybody to agree on that direction. That's the polarity between the two. Given the two, I would imagine that M&A would be a better solution, at least to me. At least to me. But over this period of time, since I've been around in the exchange, I realized one thing, at least in the case of ASEAN, the exchanges seem to be like national asset or having national mandate. That being the case, would an M&A be possible among the ASEAN, at least from the ASEAN exchanges perspective, which means to say, I have 50% of Thailand or Philippines take 50% of that. To a certain extent, I think based on the previous M&A exercise in that region, that's not quite possible. Hence the reason why I think this collaboration, the alliance is a little bit more possible. But of course, I would prefer a mini version of M&A, which means to say, to achieve our objective of this collaboration among ASEAN, the disruptive approach to achieve the end result would definitely give a little bit more numbers or bite for this panel to actually to chew on. That's what I think could have been. We could shave a few years if M&A were to take place. But to that, I don't think it's at this stage possible within the region I'm coming from.
Thanks. Bob, if you can give your opinion in 2 minutes. Yeah. We have some...
M&A, I think is more complicated in China capital market situation, because I think just mentioned 6 exchanges, only 1 is a company. The rest of 5 stock exchanges still a member system. So it's hard to to do such M&A cooperations. So for the linkage, maybe at this present is like a project. It is maybe more easy to reach. But it depends. It also depends on the case by case, because if we looked at our example in Frankfurt, it's a joint venture. I mean, according to the German law and European law, it's a company. So maybe on this project, we can do some M&A in the future. Still, I mean, according to the for emerging market, it will depend on the law development. Right. Yeah, if that happens, maybe in the future. Yeah.
How would you, Oscar, leave?
I mean, they've made really valid points, and for us, the additional considerations, actually, if you look at the West African setup, 2 of the exchanges are mutual exchanges, and 2 are owned by the government, right? So we're not set up to do M&A activities yet. We would have to demutualize or privatize in order to get there. In Africa generally, the countries really look at their exchanges almost like their national airlines. You know, they're very protective of these exchanges. And so the possibility of getting regulatory approval for a cross-border M&A is pretty slim. And we see it even in efforts to have hosting services so that you can share the cost of running your technology. And the key question that always comes up is, where is the hosting going to be, right? So if it's going to be in Nigeria, how can I sit in Cote d'Ivoire and explain to my government that my computers are in Nigeria? You understand? So while M&A would allow you to achieve the kind of synergies and the kind of speed that you need to deliver on the objectives, is just not possible right now. And so the next best thing is linkage.
Gerardo,
Yeah, very short. I think that very pragmatic. It's something that has to, what works better for the market, I think it's good. There are many ways in which you can manage or a merger or more linkages, but I think that as a regulator we have to take into account what the market needs and also in some way what the culture of regulation and all of the country's participants are going to allow for the process. No? So that's my answer.
Can I add just one? Sorry, can I add just one more point? Yes. Just now I was wearing the ASEAN hat. I'm trying to remove that to wear a Bursa Malaysia hat. In our case, we do have a partner with CME under our derivative business. With that, our business have grown, at least from the crude palm oil perspective, or easily around 200 to 300% over the last few years. So while that disruptive portion allow us to network and use the CME network to grow, I think that possibility would most probably grow and have a lot of synergy if we can go towards the disruptive approach. But then again, on an overall basis of ASEAN, my first opinion remains on that. Sorry.
Well, I kind of just add my point of view. I think that mergers by themselves, will probably just add value to the corporate, let's say, based on corporate savings and so forth. But however, there are some intangibles to it that I think are important to consider, particularly in markets like ours, and I'm talking about, let's say, Peru or within MILA, no? And it does give you some more empowerment for being able to achieve changes that are needed for further integration. So I do think that yes, a merger will be able to give us this strategic alignment first of all. It will probably help us in dealing with one more, let's say, issue or challenge that I think are within these integration processes, and is how you distribute or how you distribute the benefits of the business model, no? And I mean, those are issues that will always come to the table when you start thinking about developments or the next steps. And if you have a single corporate way of thinking, then therefore those types of decisions will be much easier to be supported by the authorities and finally by the market. So I'm really pro-mergers in terms of, and it depends also in the model. I think that politically it's important to keep. I mean, we had an exercise, not an exercise, it was really a real case with Colombia a couple of years ago in which we tried to do it. It failed at the end because of political reasons, but I think that those depend finally at the end on having the proper support from political and seeing the structure that finally satisfies the expectations of not just the private sector, but also the public and government and regulators. So I think that, and they add value in the process of further increasing the integration among countries and therefore the benefits and liquidity of them. So again, I think we run out of time, unfortunately, for this panel. We've run over really in the amount of time. So thank you very much. I don't know if there are any other questions, but if they are, I think that all the panelists here will be joining us for lunch, and feel free to address us, and we'll be happy to address the questions or the answers to you. Thank you very much to all of you, and please, if you can join me with a round of applause for the panel members. Thanks.
Thank you, Francis, for an awesome panel. We'll start again at 11:15. We'll have a shorter coffee break. Please return for Tajuddin Singh from IOSCO after the coffee.
It's a beautiful, beautiful life. Beautiful, beautiful life. Beautiful, beautiful life with you. Anywhere you wanna go, I follow. Mountain or river low, I follow. Take me to the bottom, drown me in love, wherever you go. Mountain or river low, I follow. Beautiful, beautiful life. Beautiful, beautiful life. Beautiful, beautiful life with you. will show you everything. 'Cause lately you're all I've been craving. Stuck with my heart aching. See the sun setting, you're the one. I'm falling, I'll be yours. Just don't ignore that I need your arms. I just wanna know if I'll be sleeping here alone, or if I'll be held again. Don't make me sleep alone. Don't make me sleep I just wanna know if I'll be sleeping here alone, or if I'll be held again. Don't make me sleep alone. Don't make me sleep alone. Oh, I know why you're chasing all the headlights. Oh, 'cause you're always trying to get ahead of life. Baby, when you go, you know I'll be waiting on the other side. And I know it's cold, but if you stayed in, I could keep you warm at night. Don't be a fool for the city nights. I know it's cool, but it's only light. Baby, with you, I could never lie. Don't go chasing all the headlines. Oh, I could feel the beating of your heartache drum. Oh, don't know if I'm dreaming or if you have gone. Every time you go, hits me like a bullet from a golden gun. Yeah, I know it's cold, but if you stayed in, I could give you all my love. Oh, and don't be a fool for the city nights. I know it's cool, but it's